Swayam Prabha. Digital India. Educated India.
योगः कर्मसु कौशलम्.
Friend, Namaskar. My name is Dr. S.C. Sardar, retired professor, SD School of Gujarat University. Friends, so far we have acquired information about Introduction to Final Accounts of Sole Proprietary Concern. Now we will be continue with Part 3. In Part 2, we had acquired information about items to be shown in the credit side of trading account, closing entries for preparation of trading account, format of trading account, illustration on preparation of trading account, what is profit and loss account, features of profit and loss account, purposes of profit and loss account, and items to be shown in debit side of profit and loss account. In this Part 3, we will discuss about items to be shown credit side in the profit and loss account, closing entries of profit and loss account, format of profit and loss account, illustration on preparation of trading and profit and loss account, difference between trading account and profit and loss account, what is balance sheet, purposes of balance sheet, features of balance sheet. Yes, very important point, that is about presentation of assets and liability. There are two ways. Number one is in order of liquidity and number two is in order of permanency. And the last point, classification of assets and liabilities. Now, we will see entries or items to be shown in the credit side of profit and loss account. Number one is credit balance of trading account, that is gross profit, or we may have gross loss. The whatever gross profit or gross loss we are having, that we have to transfer. But here we will have gross profit and that is to be transferred to the credit side of profit and loss account. It is further credited with other incomes like interest on fixed deposit, rent received, cash discount received, gain or profit on sale of fixed assets, interest on drawings and bad debts recovered. Now friends, another item which is to be shown over here is that is closing entries for preparation of profit and loss account. As we have seen certain closing entries in trading account, like that we will have some entries for profit and loss account. But while preparation of profit and loss account, it should be kept in mind that the closing journal entries are passed in general proper. Closing journal entries means transfer of balances of all revenue accounts other than accounts appeared in trading account. The closing entries are here friends, the whatever items are shown at the debit side of profit and loss account are to be credited. So, profit and loss account will be debited and the respective accounts like salary account, rent account, interest account, advertisement account, bank interest account, bank charges account, miscellaneous expense account, repair account and depreciation account are to be credited. Like that, we will have some items at the credit side of profit and loss account and those accounts are to be debited and P&L account to be credited. So, here interest which you have received to be debited, discount received to be debited, commission received to be debited, miscellaneous income are debited and are to be credited to profit and loss account. Finally, friends, we will have either profit or loss in our profit and loss account. In case of net profit, we will debit profit and loss account and we will add this amount to the capital. It means it will be added to the capital. Then if you have loss, then capital account will be debited and profit and loss account will be credited. Friends, after having theoretical discussion on items of profit and loss account, let us see format of profit and loss account. Like trading account, profit and loss account also will have two side, debit side and credit side. Friends, kindly note here in the red font you are given items debit side and credit side. In case of profit, gross profit to be credited to P&L account and in case of gross loss it is to be debited to profit and loss account. The first item of debit side is salary, rent, then stationery and printing, postage and courier, legal charges, telephone expenses, insurance premium, business promotion expenses, repairs and renewals, depreciation, interest, sundry expenses, conveyance, then bank charges, general expenses, electricity expenses, loss by fire or theft or damage, commission, advertisement, freight and carriage outward, discount allowed, traveling expense and bad debts. Friends, here at the debit side we are having difference, that is our profit, because there is a excess total of credit side and debit side having less total. That's why difference is appeared at the debit side, and that is our net profit, and that is to be transferred to capital account. Now let us see the items of credit side. If we have gross profit, then it is to be transferred from the debit side of trading account to credit side of P&L account. Then we will have some other incomes like rent received, discount received, commission earned, interest received, bad debts recovered, income from investment, then dividend on shares, miscellaneous income, etc. So, as I have explained to you people, in the previous case we had debit side total less and credit side total more, that is why we had profit. But here it is shown that when the total of debit side is more and the total of credit side is less, the difference would appear at the credit side, and that will be treated as a net loss, and this net loss is to be transferred to the capital account, meaning thereby miscellaneous income. Friends, here the difference which is shown, that is our loss, and this loss is to be transferred to the capital account, and from capital this loss is to be deducted. Now we will study combined illustration showing accounting entries for trading account and profit and loss account. Friends, illustration number 2, we are having the trial balance we are given of Shranav Kumar on 31st March 2025. Here we have to pass the closing entries for trading account and profit and loss account. The trial balance is given to us on 31st March 2025. See friends, here in trial balance we will have two balances, debit balances and credit balances. The first we are having capital account, then we are having stock, that is our opening stock, then cash at bank, cash in hand, machinery account, furniture and fittings account, purchases account, wages account, power and fuel account, factory lighting account, salaries account, discount allowed account, discount received account, advertising account, salary office expense account, then sales account, then sundry debtors, then sundry creditors, and finally the total of both the sides is equal, that is 6,40,000 rupees. Friends, it is important to note over here, accounts highlighted with the green background are capital accounts. These accounts are directly shown in the balance sheet. All debit balances like cash at bank, cash in hand, machinery account, furniture account, debtors account would appear at asset side, and credit balances like capital account and sundry creditors account would appear at liability side of balance sheet. Rest accounts will be transferred either to trading account and profit and loss account as per their nature. Finally, we are given the value of closing stock, that is on 31st March 2025, and that was rupees 27,000. Now friends, we will see the solution of this account. Let us see the closing entries for items of trading account and profit and loss account. Friend, first we will start with the all debit items of trading account. All items are appeared at the debit side, right? All these items are to be credited. So, trading account will be debited by 3,02,000 rupees. We are having opening stock of 20,000, that is to be credited. Then purchases are to be credited by 1,50,000. Wages account is to be credited by 1 lakh rupees. Then power and fuel account is to be credited by 30,000. To factory lighting account is to be credited by 2,000. Ultimately, all these account will be closed and trading account will be debited. Like that, we are having credit side of trading account, the item of sales is given to us. So, sales account to be closed, sales always showing credit balance, and to close this account it is to be debited. That is why sales account is debited by 5 lakh rupees and trading account is credited by 5 lakh rupees. Friends, next item which is shown in the trading account credit side, that is closing stock. Closing stock always is to be obtained from our register, and in the adjustment we are given closing stock of 27,000 rupees. So, we have to pass the closing entry for closing stock also. So, stock account to be debited and trading account is to be credited by 27,000 rupees. Finally, friends, we will have profit in our trading account. So, trading account will be debited and profit and loss account will be credited by rupees 2,25,000. Friends, total items which are having at the debit side of profit and loss account are of rupees 1,65,000. So, all these respective accounts are to be credited. The first is discount allowed, that is of rupees 5,000, salaries of rupees 70,000, advertising of rupees 50,000, sundry office expenses of rupees 40,000. Like that, all these amount are to be credited, and finally, profit and loss account is to be debited. Then after, friends, we are having income, that is discount received. So, discount received account to be debited, ultimately it will be closed and to be transferred to P&L account. So, P&L account will be credited by rupees 3,000. Friends, we are having profit of rupees 63,000, and that is why it is shown at the debit side, because there is excess credits balance of profit and loss account. So, P&L account is debited by 63,000 and this amount will be added to the capital account 63,000 rupees. Now, friends, after having these closing entries, we will prepare the trading account for the year ended 31st March 2025. Here at the debit side, first item we will show, that is opening stock 20,000, to purchase is rupees 1,50,000, to wage is 1 lakh, to power and fuel 30,000, to factory lighting 2,000 rupees. And then after, we are having gross profit of rupees 2,25,000, meaning thereby is the total of credit side is more than total of debit side. At the credit side, we are having sales of rupees 5 lakh and closing stock of rupees 27,000. Finally, the total of both the side must be equal 527. The difference is appeared at the debit side as a gross profit. As per the chronological order of final accounts, first we will prepare trading account. Subsequently, at the second stage, we will prepare profit and loss account. So, we will see the profit and loss account for the year ended on 31st March 2025. Friends, as we know that we are having gross profit of rupees 2,25,000. That is why the first item of credit side is gross profit 2,25,000. Same time, we are having income in the form of discount received, that is rupees 3,000. Now, let us see the items of debit side of profit and loss account. Salary which we have paid is of rupees 70,000, discount allowed, that is 5,000, advertising expenses of rupees 50,000, and to sundry office expenses rupees 40,000. And finally, we are having net profit of 63,000, and this amount again we will transfer to capital account, and finally, the total of the both side must be equal, and that is of rupees 2,28,000. Now, friends, in case of sole proprietary concern, we have two accounts, trading account and profit and loss account. Both accounts have their relevance and utility. Let us understand how they are different from each other. Here, let us see the first item, that is expense. In trading account, we are recording all direct revenue expenses, and in case of profit and loss account, we are recording indirect revenue expenses. Next item is income. In the same manner, here direct revenue incomes will be recorded in trading account and indirect revenue incomes will be recorded in profit and loss account. Point of difference is disclosure of results. Here it discloses gross profit or gross loss as the case may be, while profit and loss account discloses net profit or net loss as the case may be. Finally, the transfer of profit and loss. Gross profit and gross loss are transferred to profit and loss account. Net profit and net loss are transferred to capital account. Friends, now we will study the last component of final account, and that is balance sheet. First of all, let us understand what is balance sheet. Out of three main components of final accounts, first two components are in the form of accounts, that is trading account and profit and loss account. But third component is balance sheet, and that is in the form of a statement. After closing, all revenue accounts are transferred to trading and profit and loss account, while balances of all capital accounts means balances of all real accounts and personal accounts are transferred to balance sheet. All credit balances of capital nature are transferred from trial balance to liability side of the balance sheet and are transferred to asset side. Balance sheet is a statement of liabilities and assets which prevailing in the business on the last day of accounting year. These balances of liabilities and assets are presenting financial position of the business. That is why the title of balance sheet is balance sheet as at dash dash year. For example, balance sheet as at 31st March 2025. Now friends, next point is about purposes of balance sheet. Let us study them, purposes or need or importance of balance sheet. From this, we can come to know the financial position of a business at a particular point of time. This is very important point. Then second item is to know the amount of assets it owes under various heads, say debtors, fixed asset, etc. To know the amount of liability it owes to outsiders and the proprietor. It shows the changes in opening capital due to additional capital, capital withdrawn, profit added or loss deducted. So friends, after having understanding on purposes of balance sheet, let us see the features of balance sheet. Number one is it is prepared at a particular date and not for a particular period. It is prepared after the preparation of trading and profit and loss account. This is the reason why the profit and loss account, including the trading account and the balance sheet, are together called final accounts. It shows financial position of a business as a going concern. Next is balance sheet is not an account but only a statement of assets and liabilities. On the left hand side, the liability of business are shown, whereas on the right hand side, assets of the business appear. Total of asset side and liability side should match, that is, total of both the sides of balance sheet should be equal. If total of both the sides do not match, it means there is an error. Now we will see the presentation of liabilities and assets in the balance sheet. It is known as grouping and marshalling or arrangement of balance sheet of assets and liability. Friends, it is very important to note over here, there are two ways to show assets and liabilities in the balance sheet. These two ways are, number one is in order of liquidity and number two is in order of permanency. Let us see what is this. In case of presentation in liquidity order, most liquid liabilities and assets are shown in initial part of the balance sheet and subsequently less liquid liabilities and assets are arranged. We will see format of balance sheet in order of liquidity. Let us have a look on that at liability side. The first item is bills payable, sundry creditors, then bank overdraft. Friends, these are all current liabilities and their liquidity position is very high. Then after we are having loan may be of longer period of time and that is why it is appearing after bank overdraft. And finally, capital would appear in that we will have opening balance, we will add profit in that and we will deduct drawings from that. Now, let us have a look at the asset side. At the asset side, the first most liquid asset is cash in hand. Then after a number is appearing of cash at bank. Then bills receivable, debtors, closing stock. Investments are of two types, of short term and long term. As per the nature, we will decide the place of investment. Then after fixed assets, first part is furniture, plant and machinery, land and building and goodwill and so on. So friends, that was the case of presentation of liquidity. Now we will say the case of presentation of permanency order. In permanency order, time factor is very important. Assets and liability which are having longer life would appear first in the balance sheet like non-current assets and non-current liabilities, and after that current liabilities and current assets would appear in the balance sheet. Let us have a look on the format of balance sheet in order of permanency. Let us see the first item of liability side. The first item is capital. Then after here in capital we will have our opening balance, we will add profit in it, we will deduct our drawings from that and we will show the final balance of that. Now, we will see loan which are having a time period of more than 1 year. Then we will take all current liabilities. In current liabilities we include bank overdraft, sundry creditors, bills payable and other things. Now, we will have a look at the asset side. At the asset side, the first item title is non-current assets. In non-current assets we can include goodwill, that is intangible assets, land and building, plant and machinery, furniture and investment are tangible and fixed asset. Then after we are having current assets, closing stock, debtors, bills payable, cash at bank and cash in hand. So, here we have observed two types of order of balance sheet, liquidity order and permanency order. Now, friends, when you are preparing the final account, at that time it is very much essential for you to know the classification of assets and liability. There are different types of assets and different types of liabilities and their rules are also different during preparation of final accounts. Their places are also very clear, very precise and accordingly we have to pass the effect in our final accounts. Therefore, let us have a understanding on classification of assets first. So, assets in the balance sheets are categorized as non-current assets, investments, current assets and fictitious assets. The first let us have a look on non-current assets. Non-current assets are fixed assets and fixed assets are those assets that are required for continuous use and not for resale. They may be tangible assets like land building, plant and machinery, furniture and fixtures, etc. Tangible fixed assets are those fixed assets which can be seen and touched. Fixed assets may be intangible, assets like goodwill, patent, know-how, trademark, computer software, etc. Intangible assets are those fixed assets which are not in a physical form. It means they cannot be seen, cannot be touched. Now, friends, important point pertaining to tangible and intangible assets, that is about depreciation and amortization. Friends, note here fixed assets, tangible assets shown in the balance sheet at a cost less depreciation, while fixed assets means intangible assets are shown at cost less amortization. Next item of asset side is investments. Investments are capital expenditure incurred on purchase of shares, debenture, bonds, etc. to earn interest, dividend and other benefits. Investments are shown separately in the balance sheet. Third item is current assets. These are the assets of business which are held for resale or for converting into cash. These are the assets which are likely to be realized within a period of 1 year or during the period of normal operating cycle. A business earns profit by sale of these assets, but not by keeping them in hand. Examples are unsold goods, that is closing stock, debtors, bills receivable, bank balance, cash in hand, etc. These assets are temporary in nature and may change from time to time. These are sometimes referred to as floating or circulating assets. Fourth assets in the balance sheet to be disclosed is fictitious asset. There is another category of assets called fictitious assets. In the real sense, they are losses yet to be written off. Examples of fictitious assets are advertisement, suspense account, discount on issue of debenture, profit and loss account, debit balance, etc. After having information on classification of assets, let us have information on classification of liabilities. Liabilities are shown in the balance sheet on the left hand side. They may be divided as non-current liabilities, current liabilities and contingent liabilities. Friends, the first item of liability side that we have discussed, that is our non-current liabilities. Non-current liabilities are of two types. One is for external persons and number two is for owners fund. So, here owners funds are treated as a non-current liabilities. These funds are provided by the owner to the business as a capital. It includes undistributed profit and reserves in addition to capital. It is equal to the net assets of the business and is defined as the difference between assets and liabilities. Friends, third item is our current liabilities. These liabilities are payable by the business within a year. Examples are trade creditors, bills payable, outstanding expenses, bank overdraft, etc. And the fourth item of liability side, which is not the part of a total, but we have to disclose it because it has some legal importance. Contingent liabilities. Contingent liability is a liability that becomes payable on the happening of an event. In case the event does not happen, no amount is payable. Such liabilities are not accounted and are not shown in the balance sheet. They are disclosed by way of a note. Examples of contingent liabilities are disputed claims, liabilities in respect of bill discounted, etc. Now, friends, we will have a look on our concluding remark. In this part 3, we have studied about items to be shown credit side in the profit and loss account, closing entries of profit and loss account, format of profit and loss account, illustration on preparation of trading and profit and loss account, difference between trading account and profit and loss account, what is balance sheet, purposes of balance sheet, features of balance sheets, presentation of assets and liabilities. One is in order of liquidity and second is in order of permanency. Then we have observed classification of assets and liabilities, then format of balance sheet. Dear friends, we have required theoretical information about three important components of final accounts, that is trading account, profit and loss account and balance sheet. In part 4, we will discuss about basic problems on preparation of final accounts. Thank you.